Andrew Olsen, Conscious Wealth Advisor, Conscious Wealth Manager. Great to have you. Taking the place for JP, who is on paternity leave with cute little Owen Matthew. And this is just a kind of foreshadowing of what's going to come next year. I'm going to spend more time with everybody on the team and make shorter videos. And I just like to ask you, and what is new in your world? What do you find interesting?
Yeah. Well, thanks for having me on, Brandon. And yeah, what I've found interesting is I've been looking and I check this, semi often at the Fear and Greed Index, which is an index that CNN Money or CNN Business established in 2011 or 2012, about 15 years ago after the Great Financial Crisis. And what this index does is it's a quantitative aggregation to create a qualitative result. And so it's a scale with a ticker, it's a sliding scale. And essentially, you have extreme fear all the way to extreme greed. And then in the middle, you have a neutral outlook. And what it is doing is taking several different quantitative data points, like I said, and creating a qualitative result. And so I'll just go through a couple of, what it measures when it's looking at the data. So it measures things like market momentum, stock price strength, stock price breadth, put and call options. So what kind of bets are people placing
Interesting.
on the market?
Yeah.
Volatility, it's measuring, obviously, using the VIX, safe haven demand, and then junk bond demand.
Yeah. Interesting. Yeah.
Yeah, very interesting indicators, right? And I think that what's particularly interesting right now is right now we're sitting just under neutral, but in the fear category on the market. And so to put that in kind of like historical context here, we can look at a couple of different places that the fear and greed index has been.
Before we go to those places, I just want to put it into context for all of our clients and anyone else who's listening to this, is that the two emotions that drive the markets, we say anecdotally, are fear and greed. And so fear is when the markets dips down, and we have this like graph we can probably put up there. It's like a roller coaster. When there's a lot of fear, the market goes down, and then it comes back up on this roller coaster loop. And there's a lot of greed, and then it goes back down because people get too greedy. And so it's always interesting to see, is the market, not is the market high or low, but is the sentiment behind it and the investors feeling fearless, or are they feeling very fearful?
Yeah.
Yeah.
Yeah, absolutely. Yeah, that's great context. And yeah, I mean we can take a look at a couple of like key moments, and this is a predictive indicator, but it's as predictive as it ends up being.
Sure.
And it's been right and it's been wrong. But some of the times, it was very correct. Was the all-time low of the fear and greed index was in March 2020. So
Yeah.
that makes
Yeah.
total sense, right? And the market, each and every time, me and you or me and JP or whoever, the entire investment committee are looking at the S&P 500 graph, it always catches my eye, that sharp dip in 2020. I mean, no matter how high things get, it's still on there. And that's when the fear index was at the max. And if you look at it, if you had, bought on that indication, it would have been the perfect place to buy.
Sure.
Um,
And so now you're saying we're in the middle, which is very interesting, because stocks are at all-time high, but you're also saying people don't feel very good about it,
yeah.
which echoes a lot of what's happening in the economy. Consumer sentiment isn't great either.
Yeah, totally. And, it is the tale of two cities in some respect. I mean, we have what people say and what they do, and they're not always the same thing. And I think that's why this is an interesting thing to look at because, you and I mean, and JP, and we're always in and out of these meetings, and we talk to people, and we do hear a lot of, concerns and fears expressed. And that makes total sense from a money psychology perspective. We've talked about before, people feel the negative emotion more. I mean,
Sure.
this is a basic principle of money psychology. 20% up does not feel anywhere near as good as 20% down feels bad.
That's right. Yeah.
And
Yeah.
so, we hear a lot of that. But then at the end of the day, people are still placing money in. And so a lot of times I hear people kind of saying like, well, I for these people or for this, it's bad. But for where I am, it's actually just fine. And people are not alone in feeling that way, because it looks to me that, the broader market kind of feels that way. And actually, as we're talking, we just ticked up into the neutral territory as 45. It's a live indicator, so I'm just looking at it here. But really, it
Yeah.
is the tale of two cities.
Well, and that echoes the K-shaped economy that we talk about,
Yes.
where people who own stocks and who have wealth in this country feel very wealthy,
Yeah.
and those who don't, which is the majority of people, can. I paid $4.50 for a piece of toast yesterday. It seemed like a lot of money to me. It wasn't all that good.
Wow.
So there is that push and pull, or that divergence, really. I find it interesting that we're moving towards neutral on this index, because we're not done yet with this year, but everybody but Conscious Wealth is making their predictions for 2026. And and it seems to be echoing what I'm hearing in the 2026 predictions. What are you hearing?
Yeah, no, I mean, I'm hearing across the board very average positive returns. So
Average positive returns. Yeah.
exactly. So
Yeah.
if you were to take a 30-year, let's say more than that, actually, let's say a 50-year regression of stock market returns, we talk about this all the time, you'd find that the return falls, depending on what index you're looking at, somewhere between 7 and 9%, right?
Yep.
Maybe some indexes double digits, but they are not really that old of indexes. But generally 7 to 9%. And that's kind of the market prediction by the big people at, JP Morgan and Morgan Stanley. And they, I've read some of their market outlooks, of course, and them and even Merrill and Goldman Sachs are all kind of on the same page that it's going to be average positive returns. And again, I see the justifications. I'm like, okay, I hear that you can make that case. However, it's a very safe bet to place, right? And it's kind of like betting that inflation's going to be at 2.9% or something like that. It's like, okay, or 2.2%. Like, okay, well, that's a good bet because it's been true in the past, I guess. And that's kind of where people are sitting there. To me, it seems very neutral, right?
Yeah, I think it's important to take these reports with a grain of salt. They're marketing reports.
Yep.
They're not selling, as you say, aluminum siding, right?
Yeah.
They're selling stock. And so they're not going to say next year is going to be terrible. In fact, I remember times when analysts did that, and there was a lot of pushback within the company. And I was working for one of these really large companies. So they're going to say they're positive returns. And for them to say, hey, we're going to have normal positive returns, can be expected. We don't know what 2026 is going to bring us. There's entirely too many variables, but there is a lot of reason and a lot of outcomes on the possibility of outcomes that show it'll be a positive year.
Yeah.
Right. So we shall see. We haven't finished up 2025, but we still have a lot to do before this year's over. So I'm going to let you get back to your desk and I'm going to get back to mine. I thank you for coming on. And I look forward to 2026 when you bring more ideas to our clients and anyone who's listening, oftentimes entrepreneurs who are growing or scaling or exiting their business. And well, I'll see you then.
All right. Yeah. Happy holidays. Thanks for having me on.
Thanks. You too.